Hey, what's happening, options traders, and good morning, everyone. A while back, I posted a video about a strategy called a box spread. And I showed some interesting connections within the box spreads and how you can use them to make decisions about other strategies. And I also mentioned that there are similar types of strategies out there, and one of them is actually called a time box. And as the name implies, yes, a time box is very similar to a box spread. Just has a little twist to it. So what is a time box and how can you make use of it? Well, first let's do a quick review of the box spread. So recall that a box spread is really two vertical spreads within a given expiration. So let's say that we're looking at maybe January expiration and we buy the 100 strike call and sell the 105 call right here. That is a debit spread. It's a bull spread. Over under the puts, we buy the 105 put, we sell the 100 put. That's also a debit spread. It's a bear spread. So we've got two debit spreads, and this is making up the box spread. As I mentioned in that previous video, it's a little easier if we look at it horizontally. So let's take a look at the 100 strike. Those two options right there, the long call and the short put, at the 100 strike make up what's called a synthetic long stock position at 100. So for those of you familiar with synthetics, and I do have videos in this forum talking about that if you're not really familiar with synthetics, but the position of a long call and a short put will act just like long shares of stock. And so that's why they call it a synthetic stock position. Down below, we have a synthetic short. We're long the put and short the call. And so, yes, you guessed it, it's going to behave like a short stock position. So think about it for a moment. If you buy shares of stock for 100 and you sell them at 105, that's a $5 gain. And it's guaranteed to happen. Now, before you get too excited and say, oh, this is the strategy for the road to riches, remember that price is the equalizer. You'd have to pay for it. And in today's low interest rate world, this might cost you $4.95 to have it mature to $5. After commissions, you're underwater. So the box spread by itself isn't really a strategy that you'll ever use as a retail trader, but it can be a very invaluable one for understanding relationships in strategies you will use. Now, as a side note, as I mentioned in that previous video, the reason it's called a box spread is for the way it's laid out like this in your broker's platform. Those quotes, if you connect them, form a box. I know, not the most creative name, but that's where the strategy name comes from. That's why it's called a box spread. So again, as the name implies, a time box is very similar to a box spread, but we're just going to do a small adjustment. Instead of selling synthetically short right here at 105 within the same expiration, we're going to move this 105 strike out to a different expiration. So the time box is going to be synthetically long at one strike and one expiration and synthetically short at a different strike and a different expiration. So this is what it will look like graphically. So let's say that we have January expiration up on top and we have April down below. So as I mentioned, we're going to buy the 100 call and we will sell the 100 put up here in January. So that's a synthetic long stock position. It's the same thing as if we bought shares of stock in January. But now what's going to happen is we will end up selling them in April. And we're going to do that by selling the 105 call and buying the 105 put. So once again, synthetic long in January, synthetic short in April. So here are some insights into the strategy. This is really what makes it tick. If we put this position on, at January expiration, one of two things are going to happen. Either the stock is below 100 or it's above. And if it's above 100, we will exercise our long call and we will end up buying shares for 100. If it's below 100, we will get assigned on this short put and we will end up buying shares at 100. So no matter what happens, we will end up being long shares of stock in January. Now, keep in mind, because we have to pay for these shares, we're going to have $100, or actually $10,000 for the 100 shares, deducted from our account. And we're going to be missing out on interest. And that's part of the puzzle of understanding a time box. So we're going to be holding this stock position, and then in April, we're guaranteed to sell it for 105. So there's not really any risk from the sale. How will this happen? Well, again, if the stock is above 105, what will happen? We will get assigned on the short call, and we will sell those shares for the 105 strike. If the stock is below 105, we will exercise our long 105 put, and again, we will sell those shares for 105. So no matter what happens, we're going to be buying shares of stock at 100 and selling it at 105. So that's a $5 gain, but it's occurring over a 3-month period, because we're going to end up buying these shares at January expiration, and then February, March, April is when the sale takes place. So this is really a 3-month time box. So let's jump over to an Excel spreadsheet and find out what makes a time box tick. So to show the inner workings of a time box, I'm going to start with a strategy called a jelly roll. Yes, that is a strategy, and there is a video in this forum on jelly rolls if you wish to review it. But what we're going to do with a jelly roll is we are going to take a synthetic long stock position in 1 month, and we're going to really unwind it or flatten it at a future date. So notice that I'm synthetic long here in January, and then I'm synthetic short in April. So what's that worth? Well, again, if you think about it, there's no risk. We're buying the stock at 100, we're selling it at 100. The only thing we're doing is missing out on the interest. So how much interest is there? Well, as a basic interest calculation, it's $100 times 5% times a quarter of a year, 3 months. So we would be missing out on about $1.25's worth of interest, and that's what the jelly roll should cost. And there we go, pretty close. Now the reason it's not lining up exactly, that there's a little wrinkle in the way that the Black-Scholes models calculate interest, but you can see pretty close. So again, the reason that you would be receiving a $1.22 credit for this position is that's really all the damage that's being done. That's what you're missing out on, the interest, by having to execute this strategy. So the jelly roll is just accounting for the lost interest. Now down below we have the box spread. And here are the prices according to the pricing model. And you can see, as I mentioned in the presentation, you're going to be spending a lot for it. Here you're going to spend $4.98 to be guaranteed to collect 5. So again, after commissions, not really worth it. But that doesn't mean you don't want to understand these strategies, because they can give you valuable insights into others. So now that we have a box spread and a jelly roll, here's the time box. So again, using these option prices from a pricing model, we can see that it would cost $3.70 for the time box. Notice there's a big difference. It costs us almost $5 for the box spread. Why is it so much cheaper for the time box? Because you're buying for 100, you're collecting 105, but you're having to wait a lot longer. And therefore, it gets discounted more. Think of it like a bond. If you buy a 90-day bond, you're going to almost pay the full face value for it. But you could do that same setup with a 30-year bond, and it now gets ridiculously cheap because it's being discounted for such a long time. That's all that's happening here. We're just discounting it over this 3-month period. So why would it trade for $3.70? Because that's the missing interest. So again, if we're missing out on $1.25's worth of interest, that should be closer to $3.75, but again, there's some rounding errors in here, and because of the way the interest is calculated, it's not adding up exactly. But this is the idea behind it. So how could we use this? Well, for instance, we know the value of the time box, and that's a lot easier to determine. That's just mathematically based. So let's take the value of the time box and let's add it to the value of the jelly roll. Also easy to determine, very mathematically based, and we find out it's worth $4.92. And now I know that's what the box spread should be trading for. So again, it's not lining up exactly, but pretty close. And because the box spread is 2 vertical spreads, that can greatly help me to decide which vertical spread might be better. Or if one is relatively cheap and one is relatively expensive, I could buy the cheap one, sell the expensive one, maybe do a condor. But I can see these relationships because of these pricing differences here between the jelly roll, box spread, and a time box. What else could we do? Well, I could say that the value of the box spread, and if we spin out the jelly roll, we should get the time box. And again, we're off by about 6 cents, but that's the connection between them. So the main thing that I just want to show for traders, and especially for all the new traders, is why it's so important to understand, as I like to say, the art and science of options trading. Because if you understand the details, that's when the opportunities become a lot more apparent and they make profits a lot more probable. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.